Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. The retailers coming in with some numbers here today. Target, TJ Maxx. We got Walmart tomorrow. Let's roundtable this thing with some smart folks. Jen Bartashus, Senior Industry Analyst with Bloomberg Intelligence. And Bloomberg News, Jen joins us via the cam from the Princeton office of Bloomberg Intelligence. And then we got Simone Foxman. She is a Bloomberg reporter for Bloomberg Television, joining us here in studio. Jen Bartashus, let's start with you. TGT, Target, stock's up over 5%. The market, what is it like here out of the Target results?
Well, when we look at Target, what the market likes is that margin is up, and it's up significantly over last year. At the same time, I think everyone recognizes that it's a difficult operating environment, and so even though Target reduced its full year guidance for sales and for profit, I think that people are encouraged by the way that margins are responding even in that environment.
All right, so Jen, just for our viewers on YouTube, I want to point out that you have what is probably the best quote-unquote office in Bloomberg. It is a kind of a corner office. Now, no one at Bloomberg has offices. We all sit at our desks in kind of the bullpen style, but Jen has got about as close as you can get to a corner office. I just want to point that out.
That's
and that is because
setup.
She's been running the Princeton office for decades. I mean, she's basically the leader down there, so we were able to bring her to BI, so that's pretty cool. All right, Simone.
Simone Foxman sits near a window.
She does sit near a window.
I also sit near the great Michael McKee, who's a frequent Bloomberg radio guest. But
exactly.
I once had my own office because I was the only correspondent in the country. So
nice.
That's
but
when you're
anyway,
in Qatar.
Yes.
Yes.
You want to hear about retail in the United States.
Yes. So what do you got here on our good friends at TJ Maxx?
Yeah, I mean, beaten a raise.
Okay.
Really, right across the board, raising their outlook for the year, seeing comparable sales 3 to 4%. I mean, the idea, value is attracting customers. They're seeing increased traffic across all their major brands, according to the CEO there. Even home goods, that was not expected to do quite so well. Comp sales there were expected to be slightly in the negative, but we saw 4%. Year-on-year rise. So even though consumers are looking away from their homes, they've spent so much time there, they've invested there during the pandemic, and they are moving on, home goods is still able to attract people. So a broadly very positive earnings report for TJX, though I will say shares 3.6% higher, not the 5+ that we're seeing in Target.
All-time high for TJX.
That's
I will
true.
point that
That's
out.
true.
All-time high for the stock.
Well, I mean, are people stepping down? Are we starting to see that? Jen, for a long time we've been hearing guests come in the studio and tell Paul and me that people step down from Target to Walmart. Are they stepping down from Target to TJX?
Well, I think across the board, you're talking about what we consider to be a flight to value. And so regardless of where your household income level lies, people are increasingly seeking value. And that's one of the things that makes TJX such a great opportunity for people, in that there's something always new. They go in, it's treasure hunt. And if you're talking about the Walmarts and the Targets of the world, you're seeing consumers shift into areas where they think there is value. So there are some shoppers who have moved from Target to Walmart, especially when you're talking about essentials, where Walmart's prices are just generally very, very sharp. But we're also seeing people move from Walmart down to dollar stores. So it's really that progression of the flight to value that is really describing the current economic environment and the consumer environment that we're seeing.
And I think when you think about it too, the area we've heard folks across the consumer space be really negative is those middle income consumers who want to cut their discretionary spending. And TJX offers a bit more of that discretionary spend. So instead of going to the top line retailer, you have people going out and saying, I want to do that treasure hunting. I think that is a better use of my wallet than just simply going to a store where I don't have to do that,
Right.
but I'm also going to pay.
And Simone, I noticed, kind of what was unusual for TJ Maxx here is, okay, they beat the quarter, but unlike Target, who was cautious in their outlook, they boosted, TJ Maxx boosted their outlook here. So what's kind of the driver there?
Extremely strong commentary saying
Really?
that they're off to an incredible, a very strong start, I believe is word for word in the third quarter. So I think everyone very optimistic there that this flight to value, as Jennifer was talking about, will continue, even if a recovery to some degree materializes in the way that Target has been, I guess, hoping and praying for on their call.
Jen, what do you hear about the excess savings? I heard someone this morning, I think Carl Riccadonna on Bloomberg Surveillance say that Carl Riccadonna over at BNP Paribas saying that at least, there's been a debate about whether or not Americans still have excess savings left. But he says one thing is for sure, that the lower, let's say, 3 quintiles have already blown through it and have nothing left.
Yeah, that's what we're seeing too. And there's growing use of credit card debt, or credit cards, and debt is a little bit on the rise, especially for those quintiles that he was talking about. And so those consumers are really looking for where to spend that money. And I think one of the other things to think about is that the retailers in general they still haven't gone back to pre-pandemic days of promotions and the same types of levels of sales and discounts. And so although they're offering value, that type of sales environment or promotional environment hasn't yet come back. Now, that may be on the horizon if things don't change soon, but I think it also supports why we're seeing the popularity of things like TJX. Because people aren't getting those sales at the big box retailers or some of the other retailers at the moment. And so they're looking for where they can find some of those key brands, but at a much lower cost.
Simone, what else are you looking at here in the retail space as we get some of these companies reporting earnings?
Yeah, I mean, tomorrow we have Walmart. That's the big dog there. Yep. I think shares hit an all-time high earlier this week. And so I think expectations are very high that they can they can benefit from this environment in a similar way to perhaps TJ Maxx is, that consumers are trading down. They're doing more of their spending at Walmart. Walmart Plus growing an increasing number of subscribers that are using its food businesses and that sort of thing. So that'll be an interesting data point to watch. I'm also interested, we heard from Target this morning about the impact of student loan repayments kicking back up.
Right.
Do we hear that from TJ Maxx? They have yet to have their call. Do we hear that from Walmart? We're just trying to get a sense of how much this is actually going to weigh on consumers as we head towards the fall, and then of course head towards the holiday season.
You ever been to TJ Maxx, Paul?
Probably, but
I have to say, I haven't been there in a while, but when I would go, and still if I would go today, Jen is right, or I don't know who said that about hunting for, it is an adventure to go in there because there's so much stuff, and you're going to find like 3 cool polo shirts for $29.99 that you would normally pay $100 for. So
I think that's how you can make sense of it, right?
Yeah.
When I was younger, I loved doing that so much more. And I think if thanks Bloomberg for paying me, but I think if my pennies were tighter, I would worry a little bit more about where each dollar was going, and therefore I would feel like, okay, I've put in the hard work to go and buy this handbag. Even though my dimes are tight.
But my point is, it's not even hard
Walmart,
work.
Whereas I guess you go to Target, everything's much more laid out for you.
I mean, my point is, it's actually a great way to spend an hour or two in the city, like going to a Barnes and Noble and just hanging out.
God. This is why you come.
This
to
is
New
the
York
great
City.
Matt Miller.
When I was a kid, I used to do that.
How far you fallen? Jen Bartashus, senior industry analyst of Bloomberg Intelligence, and Simone Foxman from Bloomberg. She's a reporter there, joining us, talking to us about all things retail.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
Next week, Jackson Hole. I am still searching my inbox for the invite, Matt, and I know it's there. I just can't find it, but I don't know if that's going to be a big deal anyway.
I heard they disinvited a lot of people. Remember when the Soho House canceled all the bankers' memberships?
Yes.
I think that Jackson Hole did the same thing a couple years ago.
All right, let's bring in Danielle DiMartino Booth. She's the CEO and chief strategist at QI Research. She joins us live here in our Bloomberg Interactive Broker Studio and on YouTube, so that's even better. Danielle, I guess the narrative now with our Federal Reserve and with rates is not how higher they go, but it could be how long are we going to stay here? How are you viewing that part of the narrative?
So I think the higher for longer narrative is something that markets do not want to accept. But we have to bear in mind that Jay Powell started in January of 2022, kind of like Obi-Wan Kenobi. This will happen. This will happen. This will happen. These are not the droids you're looking for. And so he's managed to really extend this narrative. And I think that, if you look at what a lot of people are starting to believe compared to 12 months ago, now they're saying we might not see quantitative tightening stop until the fourth quarter of 2024. That is a form of higher for longer, even if we see rate cuts in 2024.
All right, a very smart listener of ours kind of wrote in and asked about that. The relationship between running off the balance sheet and interest rates. You made a comment the last time you were here about that. What did you mean by that relationship?
So, we are a nation that exists. Liquidity is the lifeblood of the U.S. economy. It's 70% consumption, but so much of business investment, so much of consumption is derived from credit. And when you're pulling liquidity from the system, you end up seeing things like the New York Fed's work that shows that companies anticipate rejections being at the highest levels on record in the next 12 months when it comes to credit card, home loan, auto loans, and what have you. So that is a reflection of a credit crunch, which I've learned is a term that showed up in 1966.
Oh,
it was
okay.
born by two guys from Salomon Brothers created the term. They said a squeeze and a pinch, they might be kind of friendly. A crunch is not. A crunch can break a bone. And that's what we're in the midst of quietly. And that's what we're seeing with Moody's and Fitch and the warnings that we've got on banks.
I love that.
Yeah.
So what these two guys at Solomon said used to be people would say credit squeeze or credit pinch, but that was like too fun.
It was too fun. And
So
that's
crunch.
what happened in 1966. You had banks pull back on lending while the U.S. government had been spending a lot of money. I don't see any parallels here.
That's sarcasm for those of you who aren't watching.
And what did we see? We saw a massive pullback. So there's something to be said for quantitative tightening directly influencing that flow of liquidity or not into the system. It's something we see every Friday afternoon after the close in the Fed's H8 document. You're seeing commercial and industrial lending negative.
How much does the Treasury issuance sort of add to that liquidity problem?
Well, so the first 300 billion or so were kind of benign. You saw money move out of the Fed's facility, overnight facility. People were like, "Oh, look at this! I'm going to move it into Treasury bills, money market funds." Where are we going forward? If inflation is as sticky as the inflationists say it's going to be, then if I'm a money market fund, I'm going to say, wait a minute, I'm not going to go into bills. If I think the Fed's going to raise interest rates one more time in 2023, maybe it's September, maybe it's December, then I'll wait and I'll keep my money at the Fed, meaning they're not going to naturally absorb all of this Treasury issuance, keeping that effect benign, and you end up having quantitative tightening join with Treasury bill issuance, and you're having a double pulling of liquidity out of the system.
All right, I consider myself a pretty good reader. The nuns at Blessed Sacrament instilled that in me early age, but I'll tell you what, I am not reading the Fed meeting minutes come out later today.
That's why we have people like Danielle.
That's why we have people like
Well,
Danielle.
I went to Mount Sacred Heart, so we're like in the same, yeah.
Very good. So what will you be looking for in these meeting minutes?
The softer the landing narrative, the more they're going to stick with their higher for longer.
Okay.
So, and look, minutes can be massaged. Janet Yellen said so in 2008. She said minutes can be like any other tool in the toolbox. It's not like the minutes from a corporate board meeting or something like that. In the 3 weeks that come in between, the Fed can change what actually occurred inside that room. It's kind of like magic. So if they want to nod to retail sales being stronger than what was expected, then you can have a more hawkish tone in these minutes, and that's what I'm anticipating.
What about the difference between Jay Powell's standard line, that we're going to keep rates higher I think last time he said for years.
He did.
Yeah. So at the same time, we get a dot plot, which I know is not a forecast from the Fed, but it is each individual member's essentially forecast.
Yeah.
Right? That showed at least 1 full percentage point of rate cuts next year. How can he say we're going to keep rates at this level for years, and everybody, even I'm assuming the voters are saying no, it's going to come down 1%.
So it's kind of like, you've ever heard 1 martini, 2 martini, 3 martinis floor? So he can withstand 1 or 2 dissents. And maintain his power base. You start to get to a number like 3, and you start to say, gee, is there a mutiny on the FOMC? So we might see dissent next year from some of the more dovish contingency. He might want to hold out for longer. And that might mean that we see his first real dissent. And we've seen Neil Kashkari, who used to be the most dovish person on planet Earth, become like, we're not finished fighting inflation yet. So he's like very hawkish.
And still says we're not done.
Exactly.
Yeah.
It was just a few days ago.
Our good friends at Goldman Sachs, I guess on Sunday, put out a note saying that they expect a rate cut in the second quarter of next year. Was that just to sell books, or do you think there's something to that?
Talking a book at Goldman? Oh my gosh, I've never heard of such a thing. Look, Goldman Sachs has tremendous influence on the New York Fed. The New York Fed has a permanent vote on the Federal Open Market Committee. This is a known. So I think Goldman is definitely trying to control the narrative, and they've done a very good job of that in the past, of having a very extra large influence on Fed thinking. But Powell's not an academic. Powell was the one who brokered the Treasury scandal at Salomon Brothers with Warren Buffett in 1998 when he was Assistant Treasury, the Secretary.
That's cool.
Powell's not intimidated by bankers. Sorry.
Interesting.
One of the things that you were telling us about Powell around S&P, 3,800 was that he wants to break the Fed put. He wants to destroy the idea that the Fed is going to come to your rescue, Mr. Market, every time the equity indexes fall. Now we're at 4,500. Is it making it harder for him to succeed when the market just continues to rally as they raise?
No, it's making it easier for him. He's basically shut down the commercial mortgage-backed securities market. So that's one corner of securitization that's vaporized into thin air when in March of 2020, the entire commercial real estate industry was like, hold on, we need to bail out too. But he's actually created price discovery in a market where none existed. There was a building that just sold for 67% off of its prior appraisal in San Francisco a few days ago. So he's slowly killing off lines of speculation into the markets. I think the CLO market is next. So let the stock market be as high as it wants. It gives Powell license to continue depleting liquidity from the system and taking out some of the most speculative forms of credit creation.
Giving him cover, essentially.
Covers the word.
Yeah.
All right, so I mean this in the nicest way possible, Danielle, but you are a data geek of the highest magnitude. What data are you looking at that maybe we're not?
So I follow two things very closely. The employee retention credit, it's advertised everywhere by a man
on
Bloomberg Radio.
Bloomberg Radio. Right? It surpassed 30 billion for the first time in the month of July. So on a 12-month run rate, it's pumping $400 billion into the economy. Very real money. That's about 1.5 percentage points of GDP growth on an annualized basis. We're seeing that manifest in much higher international travel. So it's going to your top quintile of earners, if you will, and that's being actively sold. So I'm paying very close attention to active fiscal stimulus. $400 billion a year is not nothing. And dailyjobcuts.com. We've gone from 5 business closings to 9 from the summer months after the debt ceiling was resolved into August. The founder of the website said he's seeing a massive increase in companies just closing up shop in August, saying, I don't see over the horizon the holiday shopping season saving me. So I'm paying really close attention to Main Street as well.
All right, very good. Danielle DiMartino Booth.
Always good to watch the fiscal side, because not a lot of Fed geeks do. Pay close enough attention to the fiscal side.
It's highly relevant.
It's highly relevant. Danielle DiMartino Booth, CEO and Chief Strategist at QI Research, joining us live here in our Bloomberg Interactive Broker Studio, which is always a treat.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Against my better judgment, I'm told we got to talk about Washington and politics and all that stuff that happens, the making of the sausage. And if we're going to do that, we're going to go to our ace, and that is Nathan Dean. He's a senior policy analyst, U.S. Latin America for Bloomberg Intelligence. Bloomberg Intelligence, we got people who just do everything, and we got a guy who is Mr. Washington, D.C., and that's Nathan Dean. He joined us live here in our Bloomberg Interactive Broker Studio. Nathan, where I want to start is kind of with President Biden last week, seemingly getting a little tougher with China, but it seems like he kind of pulled some punches there. Talk to us about what Biden did via, I think, executive order last week with China and kind of what it means.
Yeah, exactly. So President Biden put out an executive order essentially directing Treasury to limit or prohibit U.S. investments, so primarily private equity, venture capital fund investment into China in certain sectors like quantum computing, AI, semiconductors. Now, this was a much narrower order than what had previously been anticipated. So I think the markets were actually kind of happy with that. We don't think there's going to be that much of an impact here. I think if you look at the private equity firms today, the big ones, they're about 2% below in terms of total assets with exposure to China. So this is really just a symbolism executive order. Now, the Treasury has to implement it, so things could change. And with anything in the U.S.-China relations, Biden can always pull the plug if it suits his will.
You did have at the end of last month, the House Select Committee on the Chinese Communist Party. Uh-oh. Is that really the name? The
Yep.
House Select Committee on the
still do
Chinese.
that?
Yep.
It's lucky they threw the word communist in there, so we know how they feel about them, right? That's a little bit loaded. They allege that BlackRock is investing in Chinese companies acting against U.S. interests. Now, I'm guessing this is a Republican-controlled committee. Obviously, those guys don't like Larry Fink. He's like the new George Soros for a lot on the right, but we had a story by Scylla Brush out yesterday that said BlackRock, MSCI, and other firms are bracing for tighter oversight. Is that talk on Capitol Hill going after these big Wall Street fund managers?
Absolutely. I mean, and to your point, it's actually a bipartisan committee because being seen tough on China is good politics no matter who you are. So, when President Biden put out his order, we saw a statement from that committee from both parties essentially saying that this could have gone farther and they wished it to gone further. Now, the question about BlackRock and the other firms is what is considered oversight and what is actually going to happen. Now, that committee cannot write legislation. They need the other committees to do that. And with a Republican House, a Democratic Senate, and a president who also has to stare Xi Jinping in the face at certain, events, I'm not sure there's actually going to be actionable concern for those firms. So it's mostly headline risk. Just always keep in mind that when it comes to China, Congress loves to be tough, but it's the White House that actually pulls things back and moderates it.
Well, the White House, Biden last week said that the Communist Party are bad folks. Right? He said the Belt and Road Initiative, he called that the Debt and Noose Initiative.
Well, there's a difference between calling somebody bad folks and actually creating a trade deal or, sanctions and so forth that actually, changes what we here in New York City are trading on.
All right, you're down in D.C., better or worse. You're in the swamp. You're part of it, actually, quite frankly. Let's be honest. What is the feeling in D.C. about China? How worried should the world be about U.S. and China? What's the feeling in D.C.?
So, there was this thought of, will we get into a war over Taiwan? And we have a national security analyst who has been writing about this on the terminal. The general thought on Washington is we're still years away. Okay. That this is not something that you can anticipate will happen in the next few years. And when it comes to how do you approach this in terms of a market perspective, it's sort of something that like everything that we've seen before has happened in the past. There's really, there's not been a lot of actions from China that haven't been actually done 10 years ago, 15 years ago, so forth. So, we're just still in this wait and see mode. I think if you talk to most Congress folks, they're just rather happy to blast China and get the good politics from it.
I'm pretty excited because Ohio looks like it's going to be the next state to legalize marijuana. And this is something that we're following very closely, right?
Of course.
For recreational use, that would be the 24th state. Now, it's still federally illegal. And Nathan, you follow closely the Safe Banking Act, which I think is actually moving slowly enough that following it closely is no problem, right? But the cool thing about Ohio is Sherrod Brown is our senator, the senator from the great state of Ohio, and he's also the chairman of the Senate Banking Committee. So if it's legal in his home state, does he have then more, cover to push for broader legalization federally?
Yeah, if Sherrod Brown wanted this thing done, he could have it done today. There's nothing that is prohibiting the Safe Banking Act other than Sherrod Brown and a couple of other senior senators on both parties. When it comes to the Safe Banking Act, the problem they have is, or the bill has, is timing and the procedures. Now, there's a lot of people hoping that the Safe Banking Act goes as part of the funding bill that is going to come up in September. Now, that's most likely going to end in a government shutdown, and Speaker McCarthy was talking about having a quick continuing resolution into December. That means the Safe Banking Act probably won't be assigned to that. Then you get into December. There's only 8 days where Congress is meeting per month, October, November, December, and then we're in election season. So I'm not sure the Safe Banking Act actually has a vehicle to get to passage unless Sherrod Brown steps up and says, I want this done today. And I have not seen anything that says that he's been flirting a lot of, yeah, well, I like this, but also this and so forth. And there's a whole issue right now on Senator Jack Reed has been trying to negotiate with the Republicans on, and they haven't made any headway on that.
What are you focusing on down there in D.C., legislation-wise or otherwise, that Matt and I are totally ignorant of?
Well, the shutdown, for one. I mean, just
yeah, that's big.
Well, the shutdown is actually we dust off our note every 2 years when this comes out, and when it comes to the shutdown, markets get scared within the first 2 days. And then once they realize the economic impact of a short-term shutdown isn't all that great, markets actually go up. If you look at the 30-day shutdown that happened under the President Trump administration, the markets actually were pretty much fine with it. And if you're invested in the contractors, well, most contractors, at least the big ones, have 18-month, 2-year, 2.5-year contracts. So the only people that are harmed are the contractors that work in Washington, D.C., and those of us who can't take our kids to the zoo.
See? Yeah. I mean, with Nathan Dean, you can go from China to the U.S. government shutdown to weed. All
to the zoo.
To the zoo. All in one conversation.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
Joining us in studios, Doug Baker. He's a portfolio manager, head of preferred securities at Nuveen. Doug, I'm an issuer. Why would I consider issuing preferred stock? Sell me on it.
It depends what geography you're talking about. If you're talking about the United States, most of your issuance is from the bank and the insurance sector. Those two sectors, banks in particular, issue preferreds primarily to meet capital requirements.
Okay.
Insurance companies, capital requirements, but more importantly, they use preferreds to help manage their ratings.
So if I'm an investor, do I care if a stock is preferred or not when I buy it?
Oh, absolutely. I mean, because there are several components to the capital stack. And as a preferred investor, you're actually senior to the common investor. So that's first off. So compared to the common shareholder, you're senior. But the similarity with common stock is oftentimes the payments on a preferred are considered dividends. So for individuals, you get that beneficial tax treatment in a lot of instances. So you're kind of moving up the capital stack. You're a little senior.
You're safer in the event of a bust, which hopefully doesn't happen.
Yeah, you are. Arguably, you are. On paper, you are. The reality is it just depends on the situation.
Are most preferreds, are they investment grade?
Well, most of the issuars are investment grade.
Okay.
Yeah.
Okay.
So here's how it works. If you look at the issuers, on average, you're going to find that issuers are around a single A rated institution. However, the preferreds on average are triple B rated. And it's because they're subordinate in the capital stack. The rating agencies, because of that subordination, will knock the ratings down typically 4 to 5 notches versus the senior rating of that same issuer. So you have exposure to investment grade rated companies. However, the securities may not necessarily reflect that through their ratings.
All right, so we had the little mini bank crisis. Yeah. The big banks, everybody's going to pay the price with some, I guess, higher credit, higher, more restrictions. How does that impact the preferred market and their use of, the bank's use of the preferred market?
So it's going to be, in our opinion, a lot like 2007, 8, 9, where a horrible situation, right? And earlier this year, not as bad, but still pretty traumatic. But looking forward, it's going to create a great opportunity. We're going to see the regulatory environment change, which is going to benefit the credit investor, which includes the preferred investor.
Okay.
And one of the things that we're seeing now is a big build in capital, or likely a big build in common equity capital going forward. So it's going to be at the expense of the common shareholder. It's going to dilute the return on equity, but it's going to enhance the credit profile for the credit investor, which includes the preferred investor.
So what do you like?
What do we like?
Yeah.
We like the big banks. We think that there are selective opportunities even in the regional bank space. We know that that's kind of Some people think that the regional banks just across the board are a risky area of our market. But if you actually do the work, you do the objective analysis, things like commercial real estate, while they're risks, a lot of these headlines that we had earlier this year, you apply some analysis, you do some stress testing on it, indeed a risk, but more from an earnings perspective, right? So we also like some of the spaces outside of our largest sectors, banks and insurance, like aircraft lessors. So you have aircraft leasing companies that are benefiting from this tremendous boom in air travel, and they're the ones that are financing the airplanes. And so you do have some opportunities in spaces outside of banks and insurance companies to play the preferred market. But at the end of the day, most of your exposure in preferreds is going to be financial services related.
All right. So if I buy a preferred stock, do I get a fixed rate, a floating rate? How does that all work?
It depends what you buy.
Okay.
And that's where I think active management can really help out, because there are preferreds out there that will just pay the same fixed rate coupon over the entire life of the security. And if that's a perpetual security, a lot of investors don't realize they're taking on a lot of duration risk or interest rate sensitivity risk with that. But there's also a large population of securities that they may start out paying a fixed rate coupon, but down the road that coupon can adjust. And not only does that allow you to benefit from a rising rate environment, but it also helps you control that interest rate risk, which is really, I think, the primary risk of those fixed rate structures.
All right, so what's the risk to the preferred market here? I mean, I guess I got concentration risk with the financials.
Yeah, so that's the first one that we mentioned. And then the second one we were just touching on too, interest rate risk.
Okay.
Now, in our opinion, we think that the interest rate risk is probably the one that we can manage the best. Truly, though, when it comes to financial service exposure, there's only so much we feel you can diversify away from that. So we do... oftentimes when we're having these discussions with investors and they like preferreds, they want to add preferreds, one of the things that we ask them to do is, hey, check the rest of your client's portfolio, see how much other financial service exposure is there already, because you don't want to have them take an unintended bet on a sector unless they mean to do so.
How do you first get into this? Were you doing your CFA and you're like, hey, I like this section?
Well, he went to here we go, University of Chicago Graduate School of Business, which I love the GSB moniker. They've now received $1 gajillion from Mr. Booth.
Yes.
So it's a Booth School of Business. I get it,
right.
But I'm a GSB guy. There's not a bum. I've done like a dozen Chicago MBA guys. There's not a bum in the
But they're all math people?
Yeah, well,
Yeah.
They're geeky that way, the math. Even our Lisa Abramowitz, who is super smart, she's undergraduate Chicago. So they're all good. So anyway, go ahead.
But prefers, did you pick this, or were you at Nuveen and they were like, somebody's got to do preferred, man, it's you?
I hate to say it, but it's the latter. Yeah. So when I first came to Nuveen, I was actually a derivatives guy, GSB, right?
Yep.
Would you?
Sure.
And I don't tell many people this, but I was a derivatives sales guy at Lehman Brothers.
Okay.
So that doesn't come up very often anymore. You don't throw
That's
that
awesome.
out there.
So if I'm a banker,
I lead with that.
If I'm a banker and I'm doing a new issue for Wells Fargo, you're like one of my first calls, right? You're a big buyer in the marketplace.
I would hope we're up there. Yeah. So we're typically having the conversations with syndicate desks in advance of a deal coming.
So they're whining, dining you. They're the guy. You're the guy that they need to get to.
Whining and dining's kind of gone the way of the dinosaur.
Yeah.
We don't get that.
See, that's why I got
But what
out
we
of
do
the
is
game.
we give them the feedback. We're going to be one of the largest, typically, players in a book or in a deal for someone like that. So our larger competitors are going to get the phone call too. But the nice thing about that is we get to help drive the terms of the deal in favor of our investors. So yeah, we're typically the ones that will get the phone calls before the deal really comes to market to get a temperature check of what we're looking for.
So when Paul was on the street, it was all, and I'm sure when you started as well, you were flying everywhere twice a week. You were living out of a hotel half the time, constantly face-to-face meetings. And now, is it completely changed?
It's actually going back to that. It's
it
going
is?
back, yeah.
Good.
So we're doing.
Nice.
I mean, I think we're the virtual, kind of remote meetings are. That's going to be still a big component of it. But yeah, I think feet on the ground, and I think getting involved with folks face to face in a room. Look, there's just better communication that way. And it also builds a level of trust that, hey, it's easy for me to say on the phone, like, yeah, we're going to have interest at this type of level. But to do that in person, I think there's just a different connection there. And I think having that level of trust with, our partners on the syndicate side, with our investors, is truly important. So that FaceTime, that in-person travel has really picked up I would say, over the past year or so.
How many new issues do you guys at Nuveen buy, like you, for your preferred fund? Like,
there haven't been many lately, and this is one of the technicals to our market that's been incredibly supportive valuations, and it's going to stay this way. We've had more preferreds redeemed this year than new issue can keep up with.
Really?
So yeah,
Okay.
and part of it is that, you know, as the economy slows, our outlook is banks aren't going to need as much capital because their balance sheet shrinks, right? Not as many people want loans, and if they're not making loans, well, the size of their balance sheet shrinks, and their capital is measured as a percent of their balance sheet.
Yeah.
So we're seeing more redemptions than we're seeing new issuance. But when new issuance comes, use of proceeds is almost to refinance or to call an existing preferred.
And it gets snapped up because people are looking for the preferreds. There's no supply.
They're looking to reinvest their cash. Yeah. And luckily for them, though, in this interest rate environment, the structures that we're seeing are very attractive. We're talking mid 7% type coupons with adjustable rate, you know, a component down the road after the first call date. You know, we'd be a little bit more concerned if we were in a low interest rate environment and folks didn't have this attractive opportunity. We do think that the preferreds are coming to market today are going to be a rare vintage because of these higher coupons, these attractive structures. So more often than not, we're participating in the new deals that we do see.
All right. Doug Baker, he is our go-to preferred guy, right? He's our go-to preferred guy. Portfolio manager, head of preferred securities at Nuveen.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's get right to our next guest, Caroline Fredrickson, distinguished visiting professor at Georgetown Law. Caroline, thanks so much for joining us. We'd love to start as it relates to former President Trump and his legal challenges. Why, maybe, just give us a sense of kind of where his greatest exposure is with these four issues that he's facing from your perspective.
Well, I mean, there are four prosecutions, but there are a lot more than four issues. So, you know, it looks, I mean, I guess I would start by talking about which are the most consequential. We could look at both the cases that are brought in D.C., the federal case focusing on January 6th, and the Georgia case is really being central to the concern that we have about President Trump allegedly trying to undermine our very democratic system. The other two cases, albeit important, don't have the same kind of real existential issues for the United States of America as continuing to exist as a democracy. Now, in terms of what the the ultimate greatest danger is for Donald Trump, I mean, we'll still have to see how this will unfold because we haven't seen either of the prosecutors lay out their case. I think there are a couple of different theories here, and one is that the approach taken by the Department of Justice, which has been not to name the so far unindicted co-conspirators, but to really move in a different and more focused way, is one strategy to try and really focus the attention on Donald Trump and perhaps behind the scenes to try and negotiate with those who haven't been named yet in the federal lawsuit, who include some of the same people who were actually named in the Georgia state prosecution, the Fulton County prosecutor. In that case, you know, you have 19 defendants and 41 charges. And I think they're taking a very different strategy, which is very narrative, which is telling a story and working on the potential of the defendants there turning on each other, some of them taking plea deals and so forth. So they're both very consequential for the president. It's really hard to say that they have both significant prison time for him if he is prosecuted.
I want to ask Professor, about something I saw in the Times over the weekend that I think a lot of people probably read, bringing up the possibility that according to the original meeting of the 14th Amendment, Donald Trump is ineligible to hold government office. And there was a paper written by a couple of a couple of, I guess, attorneys that are or were associated with the Federalist Society. So this is coming from a fairly conservative group, right, in which they argue that because he essentially engaged in insurrection, he is barred from holding office due to this amendment that was put in place after the Civil War. Does that hold any water, do you think?
I think it's a very strong argument. And first of all, I'd say they're actually law professors. One of them, Will Bode, is at the University of Chicago. He's very
exactly. And Michael Stokes Paulson from the University of St. Thomas.
And they're very conservative, associated with the Federalist Society, as you said, but also originalists. And I think in the sense that they went back and they looked through a lot of the documentation around the debates, around the amendments adoption. And it was clear they were not just focused on those who'd been guilty of treason during the Civil War, the Confederates, but was meant to be prospective and keep people who've taken an oath of office to the United States from being eligible to serve again in such positions of trust. There has been one successful effort so far to keep somebody off the ballot, and that was brought by a group called Citizens for Responsibility and Ethics in Washington against somebody who participated in the January 6th insurrection, and they kept him from being able to get elected. So I think it's a very strong argument. And I think we're going to see how that will play out as election officials take action in different parts of the country.
Caroline, what's your sense of the timeline here with these four cases? When will the first one, what's the timeline as you understand it?
Well, it's very fluid right now. I mean, I think the special prosecutor is trying to move forward as expeditiously as possible. And it looks like they're going to try and get that trial started before the end of the year. I mean, these things are, can keep changing. The Mar-a-Lago documents case looks like it's going to start really underway in the spring. The Fulton County prosecution in Georgia, I think that's, they have an interesting schedule of speedy trial rule. That means that any one of those defendants can demand speedy trial, which can really accelerate the pace of that prosecution, meaning that it could even be starting mid-fall, October or November. And those cases could be divided because some of the defendants might commit, agree to a plea or otherwise get severed.
All right. We'll have to, obviously, fluid situation, as you mentioned. We'll stay on top of it. Thank you very much for your time. Caroline Fredrickson, distinguished visiting professor at Georgetown Law, trying to give us a little bit more clarity as this legal issues of the former president continue.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's talk about the housing market, the residential real estate market. U.S. mortgage rate climbs to 7.16%, matching the highest since 2001. That gets your attention,
particularly. That's if you have great credit.
And
that's the gold standard mortgage rate. Because if you look at bank rate, we're already up over 7.5.
That's right.
Yeah,
that's right. So we need to figure out what's happening out there and what it means for this market. Lisa Sturtevant, she joins us. She's the chief economist at Bright MLS. Lisa, we had some housing data come out today. Housing starts pretty strong. I guess the housing industries, the home builders are trying to meet the demand out there. But what's going on in the residential real estate market today? How would you characterize it?
Yeah, it's such a strange housing market, isn't it? It's housing has really confounded expectations in so many ways. You point to the home builder data this morning. New housing starts are up from a year ago, up from last month. We're seeing that home builders are really responding not only to the demand in the housing market, which has stayed surprisingly resilient despite those higher mortgage rates, but they're really responding to the fact that inventory is really at near record lows, and there really is so little for prospective home buyers to choose from Home builders are ramping up. The amount of inventory that's accounted for by new home construction is at its highest levels really in the last couple of decades. And it's been a really strong housing market. We may be, though, prepared to see some changes in the market as we head into fall.
So what do you think the catalyst for that will be? Because I don't know what's going to move us out of this stalemate that we're kind of in right now. Owners who have low mortgages don't want to sell, and buyers can't afford the high mortgages or the prices.
Right. So we sort of expected back a year ago when the Fed started raising rates and mortgage rates were rising that we would see a real strong pullback in demand, maybe home prices would fall. But in fact, aside from a slowdown late last year, we've seen buyers back in the market in record numbers in the spring, primarily because there's just such strong demand for home ownership. A lot of folks have record levels of equity in their homes that they're able to roll into a home purchase, in essence, sort of buying down that higher rate. But as you point out, the real reason why home prices have remained firm so far is inventory has been locked down as many homeowners are in those sort of golden handcuffs of lower rates. But I think we're at a point now where there's just a lot of fatigue in the housing market, and rates surpassing 7 or even 7.5% could be what send us to a much slower market in terms of transaction level here this fall.
So a lot of folks are wondering, like myself, when mortgage rates are going to decline. And is there a level that once we get there that'll maybe free up some activity here? Is it 5%? Is it 6%? Is it 4%? Is there a rate where you think it would kind of thaw out this market?
Sure. Yeah. Right. It's not going to be 3%, right? It's not going to be back to where we were during the pandemic. I don't think it has to come down even to 4 or 5% to help free up some sellers who may be waiting to move, but feeling that financial pinch. You know, one thing that we're tracking really closely is the fact that the spread between the yield on the 10-year Treasury and the 30-year fixed rate mortgage still remains quite wide. So even though mortgage rates will remain relatively elevated here in the latter half of 2023, if we do expect, and I think we do expect that gap between Treasury yields and rates to begin to narrow, and we could see rates come down to below 6% next year, which I think is what will be enough to bring more sellers from the sidelines.
What's an historical, what's a rule of thumb in terms of that spread? Where is it typically, or has it been over, say, the last 20 years?
Yeah, we're typically around maybe 1.82 percentage points, and we're now up at 3 percentage points.
So historically, we should see mortgage rates about 6, right? And we're looking at a little bit more than 7.
That's right. And so if you imagine sort of as we move through the rest of the year that we should expect rates to come down, maybe settling around 6.5% by the end of the year, and continue to come down further as we head into next year.
All right, so I guess I'm refinancing, with a 5 handle. So,
what,
all right. That's
what about, Paul top ticked the mortgage market. But he got an arm, so he's ready to move in and pounce when the rates come back down. What about new supply coming on the market? So we know that there are very little transactions in terms of previously owned homes. Are builders out there putting up new supply like crazy so they can get them into the hands of home buyers who are willing to either pay cash or go with a 7% mortgage?
Yeah, there's been a long period of time during which home builders had a really tough time with supply chain issues, difficulty getting materials and labor. And now over the last few months, we've really seen home builders ramp up construction because there's just simply no other inventory out there. And they are having to do things to entice buyers in, though. We're seeing more builder financing. We're seeing
builder financing at lower rates, right, Lisa?
That's right. I'm sorry. Builders offering financing at lower rates to help bring more buyers in. What we're not seeing is builders dropping prices of new construction yet. And maybe they won't have to as we head through the rest of the year. But we are seeing, some sort of give backs in terms of upgrades and other things. But right now, there are a lot of home buyers who are on the lots of new houses and they didn't expect to be, but that's where they are because that's what's available for sale. I
mean, why would you drop the price? You put up a bunch of McMansions in, Connecticut commutable area, and then if you say, hey, we'll give you a 4.99% mortgage, people are like, wow, I'll pay whatever you want.
Right, and it definitely is region specific, right? We have some parts of the country where we're not seeing as much home building. Here in the Washington area, for example, we're still seeing home prices of existing homes rising even as demand has slowed, and that's simply because we're not seeing a lot of new construction that's been coming online.
So when the home builders are out there building, and again, building permits, housing starts up 3.9% month on month, much better than forecast here this morning. What are they building? Are they building those McMansions, or are they building what the market really needs, which are starter homes?
Well, the market needs starter homes for sure, but it has been a long time since we've seen new construction really be the main supplier of starter homes. But what we are seeing is a range of new construction activity in that middle market as well as that luxury market, which then allows the starter homes in the existing stock to be vacated, where folks are able to move up. I mean, it's part of a whole housing ladder, right? But because of the cost of materials, the cost of labor, the cost of local regulation for home builders, it's really financially challenging for a builder to build at very low home prices. So we're really seeing sort of mid-market and luxury construction by and large.
What about multifamily?
The rental market has been certainly going like gangbusters in many markets. In fact, we've seen that rents are beginning to come down year over year on a national basis. Rents are down in many markets across the U.S. This is all happening despite the fact that mortgage rates are higher. We're seeing just more new rental construction coming online, which is giving renters more options. So if we're looking for some sort of bright side in the housing market, people who are in the rental market are finding more options and are finding rents stabilizing or coming down.
Hey, Lisa, thanks so much for joining us. I really appreciate getting your thoughts here. Lisa Sturtevant, Chief Economist for Bright MLS.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.